Here's a lesson for you. When a high-quality company reports its earnings, don't let the stock market's initial reaction cloud your own judgment. Take Henry Schein, HSIC, biggest distributor of products and services for both dentists and veterinarians on Earth. In addition to being a major supplier of vaccines, we haven't talked about that enough. Maybe we can change that tonight. A business been in the spotlight courtesy of the unfortunate measles outbreak in the country. Now, I've been long a fan of Henry Schein, in part because it's got incredibly consistent gross margins and a strong, accelerating growth. But when the company reported this morning, the stock quickly got slammed. At one point, it's falling more than $4 before recovering to close up 77 cents. That's a huge swing. That move up in the stock after an initial decline makes a lot of sense, because the results are pretty darn good. Company delivered a 6-cent earnings beat off of a $1.50 basis. Company took market share in each of its segments, reaffirmed its full-year guidance for 2015 despite the strong dollar eating into the company's overseas profits. Now, Henry Schein has rallied 9.5% since we last spoke to the CEO 3 months ago, up more than 90% since we first highlighted it back in November of 2012. Even after these moves, you know what? It is still worth buying. But don't take it from me. Let's check in with Stanley Bergman. He's the chairman and CEO of Henry Schein. Hear more about the company's quarter and the company's prospects. Mr. Bergman, welcome back to Mad Money. Good to see you, sir.
Good to see you.
You know, when I first met you, it kind of, look, it's always been a great business, the dental consumables. But there's a little bit more of a wow factor now with both vaccines and animal health. Animal health being the fastest growing end of all health and vaccines being on the hot seat. People seem to misinterpret the quarter, though, initially because of one particular aspect of dental that really was a difficult compare, right? How would you describe that?
Well, I think, and we don't know, we haven't seen all the reports yet, but I think there was some that overreacted to a slightly negative amount of sales in the dental equipment area. That was driven really because the tax accelerated depreciation was only reinstated for about a 10-day period this year, and it was just too late.
Well, the reason why I bring that up is because I want people at home to understand when a high-quality company that has been so consistent as yours, and I regard you as maybe one of the top 10 consistent companies, has a price break of $4, don't just sell. Take a hard look, because some of these divisions you have are really on fire. The consumables, the veterinary, and we got to talk animal health. Animal health, is that the fastest growing category right now?
Well, animal health is driven worldwide by the middle class who are buying more pets. It's as simple as that. And, of course, the baby boomers.
Now, also, at the same time, the vaccine business in the news that some people are balking from vaccines. But overall, it would seem that vaccines are maybe the most important aspect of what you're doing right now.
Jim, where would we be without vaccines? Just think about it. Polio, measles, flu, all of these areas, all the baby vaccines.
Well, there are people who obviously are who are balking, who think that vaccines have a negative aspect to health. I mean, you hear that, I'm sure, in your business all the time.
Well, of course, I'm not a physician, but what I do know is the volume of vaccines that are shipped around the world, not only in this country, but in the developing world. Where would we be without vaccines?
Well, are we ready for the next epidemic?
My concern is that we have skated through Ebola, just like we skated through SARS, we skated through the Haiti tragedy. The world is not ready for pandemic planning and emergency response to tragedy. We just are not ready. We react when the event.
I mean, you know, this is something I think about a lot, especially because we have a lull right here. When we had an Ebola czar, and then the czar thought his job was done. I mean, is the job done?
I wouldn't say the job is done, but it's almost done. We had 3 failed states, healthcare states. No one worried about it. If there was a military issue, we'd be in there. But because it was health, we let them fail. We're not keeping pandemic out of this country. We're not stopping it at the borders. We need to make sure we're planning for pandemics. It's got to be public-private partnerships. Us, the private sector, working with government, working with the NGOs in the world to make sure we have a pandemic plan in place.
Okay, now let's go back over what is, I think, the major drivers. Positive demographic trends, technological improvements, focus on preventive care, and as consolidation of practitioners. Which of these drivers are going to play out best for you in 2015?
They're all working in tandem. Plus, of course, the big thing is technology. Yes, we will have more people going into primary care, into wellness programs.
Right, because of Affordable Care Act.
Affordable Care Act. So we don't have more money. So what we need to do is make sure that we prevent people from getting sick rather than take care of them when they're getting sick.
So you now regard Henry Schein more as it's not just a healthcare, it's actually it's preventative on all of your different...
That's our business. Dental, medical, it's the physician. We want to keep people out of the hospital. And then, of course, the pets is the big play, middle class, grow, a baby boomer grow opportunities.
Well, I've identified your company along with McKesson, Amerisource, Bergen Brunswick, CVS, most consistent companies that we talk about, and it's a lot of it is your work in understanding the great growth markets. And I think it remains a must-own stock for individuals at home. That's Stanley Bergman, who's the chairman and CEO of Henry Schein. Consistent growth is everything in this market. We have Money's back after the break.